Hello, everyone. Today on the final bar, my guest is Craig Johnson from Piper Sandler in Minneapolis. We're going to talk about our view of the S&P 500 for the year, where he sees things ending up. Also, precious metals, which have been on a nice run going into yesterday and today's session. The S&P having a nice recovery today, after struggling yesterday, really accelerating yesterday afternoon. That continued through much of the day with the S&P up around 37.26. So overall, how does that fit in with the big picture? Also, we're going to answer your questions from the Final Bar Mailbag. Ladies and gentlemen, this is the Final Bar. Hey everyone, welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together through the lenses of technical analysis, behavioral finance, decision-making, sentiment, breadth, price, whatever we can do to make sense of the very uncertain times that we're in. Obviously, a lot of balls in the air right now with the elections going on, the special elections in Georgia. Obviously, a lot of news flow and expectations leading up to that. So we'll have to see how the remainder of the week plays out. But so far for today, as far as today's market's concerned, certainly strength over weakness. Nice recovery from yesterday. Yesterday, the first trading day of the year, certainly weaker rather than stronger with the average stock trailing. It was about 2/3 down, 1/3 up yesterday. So it wasn't the worst day in the world, but certainly, feeling the weight of the down move. Today, a nice sort of recovery to the upside with small caps and mid caps really pushing their way higher. It's sort of back to the playbook we saw at the end of last year, including leadership from the MEI trade, materials, energy, industrials, which are 1, 2, 3, led by energy at the top of the list. We have a great guest today, Craig Johnson from Piper Sandler, coming back on the show. It's always a pleasure to hear from Craig, who just has a real good overall process, a great sense of the markets. Tomorrow, we have Chris Brecher from Brecher Trading coming back on the show. On Thursday, Bob Lang from Explosive Options joining us for the first time. Then next week, on Tuesday, the 13th, we have Doug Bush from Chart Smarter in New York coming back on the show. We are getting some plans lined up for our Market Outlook 2021 special programming. I hope you caught Reflections 2020, which is our year-end specials. We had such a fun time putting together some content that I think is still very relevant about how you wrap up 1 year's experience as an investor, as a trader, and set yourself up for success in the new year. So if you missed it, go to our YouTube channel and check out some of those Reflections 2020 specials. Our Market Outlook 2021 will be coming to you in the next couple of weeks. We'll announce it as soon as we can. Let's get to our market recap. As I mentioned, this was a recovery after yesterday's sell-off. Really, the sell-off happened in the first part of yesterday's trading. The afternoon was pretty decent. That continued on with what we saw today, with the S&P up around 37.26 at the close, up 0.7%. Mid caps and small caps, though, in terms of one theme, driving the way higher. So you had small caps rotating lower yesterday along with everything else. Now we're getting sort of a pushback to the upside. The VIX lower, just above 25 now. In terms of some other asset classes, bonds weaker today with the 10-year yield getting back up nearing that key 1% level. And when you think of the chart of the 10-year yield, it's sort of this big rounding bottom pattern, the downtrend in interest rates, the sort of wide consolidation range-bound rates, but then this rotation higher, and 1% has been the ceiling for quite a while. I think once we get above that, I wouldn't be surprised if we see some higher yields from there, but we have to break 1% first, which I think for a lot of people is sort of a psychological resistance level. Gold and precious metals up. We talked about silver yesterday. It was one of our 3 and 3 charts looking at the SLV, sort of continuing right where we left off into yesterday's close. So both gold and silver, potentially rotating higher there. They certainly have been. Commodities as a whole doing very well, with energy and oil specifically leading the way higher. That brings us to our sector review, with energy up about 4.5%. Clearly the strength out of the markets is the MEI trade at the top, with materials number 2, industrials number 3. Then we get into a number of other things sort of in 0.5% or more. On the bottom, only one of the 11 sectors down on the day was real estate, followed closely by utilities and then consumer staples. So certainly some cyclicals at the top, some defense at the bottom. Sort of a nice continuation day today. When you look at the big gainers today in terms of improvement in their scooter ranking, so this is our percentile ranking system, the StockCharts technical ranking. What rotated most positively from where it was yesterday. Most of these are all energy names. Hess, it's Schlumberger, it's Marathon Oil, it's EOG, it's Occidental. These are all names in that space with a nice rotation higher. Let's focus on a chart of the S&P 500 just to reorient ourselves. So today, a bit of an inside day, I guess, is how you would describe it. Yesterday was that bearish engulfing pattern that emerged on the S&P and on a lot of stocks. We focused on our stock picking portion of the show yesterday on communication services. We had a lot of bearish divergences and things like Charter and Comcast and others. Today sort of bouncing a little bit higher. What that tells you, the general idea of those bearish engulfing patterns, it tells you about the next couple bars should be weaker rather than stronger. That idea is invalidated if it breaks above the high of that 2-bar pattern. So if we get above yesterday's high, that means, nope, that wasn't a confirmed bearish divergence. It was invalidated and we're continuing on a higher. But overall, it's still suggesting some internal weakness, I would say, through at least the next day or two. But overall, the S&P continuing a long-term pattern of higher highs and higher lows. We didn't mention, we didn't have a chance, a show at the end of last week. Usually on Friday's show, we dig into our market trend model and talk about where it's been, just so you're aware. The short-term model for me is based on the weekly data. It just looks at where we're at relative to the 5-week exponential moving average. We're right there, so it's really close to actually registering a sell signal for the first time since last October. Last time it turned negative was on these pullbacks here in August to September, and then October of last year. It's been positive since then as we've remained in this pretty good uptrend. Most weeks have closed, or at least have at some point traded higher than the previous weeks for most of the last couple months. This week we're undercutting last week's low, and a close below that 5-week EMA would at least make the shortest term part of my my market trend model turn negative. So it's something to watch and see if we get some follow through, certainly through the remainder of this week, and then it would be into next week. Do you get confirmation, some sort of further downside? A lot of the breadth charts that we look at, some of them are updated for today, some of them not quite. A lot of our data gets sort of tabulated and confirmed after the close, so it's not quite up to speed yet. But I think one thing worth noting through yesterday's close is the cumulative advanced decline lines. When we talk about breadth, I think one of the concerns I had about the S&P going into the fourth quarter was a lack of confirmation from the cumulative advanced decline lines. And in particular, this one, so I can move the chart down here. This is the common stock only New York Stock Exchange advanced decline line. Sort of hit a peak in August, retested that in October, and didn't quite break above it. So while the S&P advanced decline line was going higher, that was not confirmed in the NYSE, which is a broader universe, includes mid-cap and small-cap names. That was alleviated when they all broke to new highs finally in November and confirmed this breakout in the S&P and a lot of the major averages. If you look at what's happened now, it's still early on, but I'm getting higher highs in the S&P. I'm getting higher highs in the S&P breadth, but we're starting to not get confirmation from the NYSE breadth line, which is there. You're also getting a bit of a lower peak potentially here in the small cap advanced decline lines. And that tends to be what you'll find at the end of a bull market phase. You would get usually divergences from the common stock only line, right? Because it's taking some of the smaller mid-cap names, some of the higher beta names that are probably rolling over first. The S&P breadth could remain positive as some of the, people flee to the relative safety of the blue chips that would be represented in that index. And then the downturn would be confirmed by a breakdown in price and a turn lower in the S&P advanced decline line. So it's still early on, but that's certainly something I'm going to be watching, is if we get a lower high in the advanced decline line. I'm not showing the RSI, the relative strength index, on the advanced decline line, but it actually is showing a bearish divergence on the AD line, suggesting a weakening in that internal measure of market breadth. So that's certainly one chart I'm going to keep an eye on to see if that continues, or what sort of movements we start to see. One thing I wanted to also note was the breadth, which is on another page. So let's go with the semiconductor index. You saw strength in semiconductors. When I think about sort of that next level down. In yesterday's show, we talked about some of the group and sector and and individual stock themes. And one that we keyed in on was semiconductors. That tends to be a bellwether group for me. When that group's doing well, things tend to be in pretty good shape overall as a market. But I see a scenario here. If we do get some choppiness, if we get some movement away from the offensive side of the ledger and into some of the more defensive sides, people sort of tap the brakes a little bit. I could see where semiconductors actually continue to do well because it's a relatively stable group. It's been a pretty solid performer. And I could see that being one of the last things that struggles, things like big tech, semiconductors, which have been some of the names that have really gotten us here. So it'll be interesting to see if that performance of the SMH and of the SOX, which is the semiconductor index, remains relatively strong. So that's certainly something to pay attention to as well. Finally, I just wanted to hit the daily advanced decliners. We talked about yesterday being a distribution day. In the end, it's all about how stocks are moving relative to one another. Yesterday, it was just under a third that were up on the day. It was just over around 70% that were down on the day. So that's not an end of the world sort of number. On really negative days, you'll get 90% of the New York Stock Exchange down. It's only 70%, which wasn't horrible. Today, a complete flip over, and you had 74% of the New York Stock Exchange closing back higher today. So certainly a broad bounce, a nice recovery. And now it's all about, what do we believe? Do we believe yesterday's sell-off has the beginning of something deeper? Or do we believe today, and yesterday was just a pause before we resume the uptrend? After the break, hopefully our guest Craig Johnson has some color to provide on that specific question. We'll be back after a brief commercial break with Craig Johnson from Piper Sandler. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. I want to thank you so much for joining us on the show every weekday after the close as we look at the charts together, try to navigate these markets. I'm excited. A little later in today's show, we're going to do a mailbag segment. We haven't done those in a couple of weeks because we took some of the holiday period off. So we had some great questions from you over the holidays. We'll address as many of those as we can. If you have questions that you want to get to us, please feel free. We'd love to hear from you and address one of your questions in our next mailbag segment at the end of the week. Shoot us an email, thefinalbar@stockcharts.com, on Twitter @finalbarsctv. Just tag us in any comment there, or on our YouTube channel, just put a question or a comment below the video that you're watching. We'll gather all of those and hope to answer one of your questions in our next mailbag segment. I want to welcome on my guest, Craig Johnson from Piper Sandler, joining us from Minneapolis. Craig, you've been on the show before, and I always, over the years, have enjoyed getting your take on the markets, and it's a pleasure to have you back today.
Dave, thanks for having me on, and congrats on Ohio State. Great win.
I should point out, Craig very kindly messaged me during the game with supportive comments. He actually played the fight song before the show over the audio, so thanks so much for that gift, Craig, and appreciate you acknowledging the dominance of my Ohio State Buckeyes. Let's get onto the markets. When you're thinking of this market environment, obviously all eyes on Georgia, which I love the title of your report today. But talk us through how you're seeing this year unfold. A lot of questions after a turbulent year, a lot of uncertainty. Where are you at right now with the markets?
Yeah, so Dave, if we think about where we are right now, I mean, clearly today is all about Georgia. Georgia on my mind at this point in time, a little Ray Charles there for us. But if we go to the next chart and we take a look at a chart of the S&P 500, no doubt we had this bullish engulfing pattern yesterday, inside day, as you mentioned earlier today. But everything that I look at, Dave, whether it's from a short-term sentiment reading perspective and some of the gauges that we're looking at, this market has run very well, and I'm going to use the word overbought at this point in time. And I'll just simply come back and say, whether it's the AAII numbers, whether it's some of the put call ratios, all these indicators to us have reached some very elevated levels that, going back through time, we've historically rarely seen. Also, you can see from the chart we put up here, look at the divergence in terms of our MACD down there at the bottom. That's trending lower while price above is trending higher. So we've got this divergence that's taking place. And what I've been hearing from a lot of portfolio managers is, hey, Craig, I get it. We're overbought. We're ahead of ourselves. And tail end of last year, they weren't going to do anything about it. It's like the year's almost done. Let's get 2020 done. And certainly was not too surprised to see the weakness that we saw yesterday in the market. But we got to start looking at some downside objectives as to where we're going to find support with this market. And I drew a few of those there on the charts. But from my perspective, 36.45, those December low price gap area, and then 35.90, 3600 range, which is kind of a milestone level, are areas we're going to need to come back and watch. But Dave, I got to tell you and certainly all the listeners that I wouldn't be surprised to see this market correct back toward about 32.50, which is back down toward this, rising 200-day moving average. We've got divergences in place. We've got a market that arguably is priced in a lot of very good news at this point in time. And I think we're going to have to see a little bit of a breather. The breadth thrust, it's been absolutely incredible. And right now, when I look at our very large database of breadth measures and everything else that we've been calculating here at Piper Sandler since the 60s, we're at levels we rarely see. In fact, if I look back just toward 87, this is like the fifth biggest breadth thrust that we have seen, and it's already lasted 8 weeks. The median, the average is about 11 weeks. The kind of midpoint is about 5 weeks in terms of how long these breadth thrusts last. So again, we're 8 weeks into it, and I think we're going to have to see some setbacks and corrections along the way. So from my perspective, Dave, this is a market that I think is still going to continue to work throughout 2021, but I think you're going to get a pretty meaningful correction in the first several months of this year. And then I think you're going to spend through the summer months rebuilding and ultimately see this market push higher toward about 42.25 at year end. That's what our bottoms up model is suggesting for us at this point in time. But Dave, if we go to the next page and talk about gold, I think this is another important inflection point. This is a little bit inconsistent. If this market's going to keep moving higher the way it is, I guess I'd put this in the defensive category. Wouldn't you agree?
Sure.
So you look at what you're seeing setting up with gold, what you're seeing setting up with silver. Last week, one of the best performing sectors was utilities. So for a market that's supposedly as strong as it is, I'm seeing some inconsistencies, some divergences, some things that suggest that perhaps we need to take a little bit of a breather.
It's such a great take. You hit on so many great things. I hope everyone was paying attention to all the little things you mentioned, from the euphoric sentiment to the breadth thrust out of the lows. There's a lot to unpack there. I'm curious, as you think about 2021. I've thought about that analog relating 2021 to 2010. Sort of the first quarter was a little rough. We actually made a new low in the spring, if I remember right. And then the second half of the year was totally different. You sort of accelerated and finished to near highs. Is that sort of the general picture that you would see things playing out in, or is it different?
I think it would be something along those lines, Dave, because right now we're at a point in time where it's sort of hope versus reality. And everybody has sort of come into the tail end of 2020 and now into 2021 with the mindset that we've got a vaccine. We're going back to normal. We're going back to baseball games. We're going to football games again instead of watching them on TV, right? And all of a sudden, it's just everything is back to normal. And I think that hope and that vision in people's minds is probably a little bit ahead of itself. I think it will happen, but probably at a later date than what most people are thinking about. Again, 1 out of every 50 people in the UK, as was announced today, has COVID. Okay, so this rollout of this vaccine, while the market has largely ignored the ramping COVID numbers, at some point in time, there's going to have to be a reality and sort of a reconciliation between reality and the economic impact. I mean, cruise lines, airlines, hotels, you name it. I mean, there's going to be an impact to the economy. And I think that's where the reality is ultimately going to set in. And that's going to lead to that kind of horseshoe kind of formation of what I think you'll ultimately see play out for 2021.
So a bit of a cautious tone here to start the year, Craig. Good to have you on. Hope you stay safe. Thanks again for coming on, and we'll be in touch, all right?
Thanks, Dave.
That's Craig Johnson. He's the technical analyst at Piper Sandler in Minneapolis. I've known Craig for many years. We served on the CMT Association board of directors for a number of years together, and boy, have always just appreciated his holistic view of looking top down and bottom up, and a lot of similarities. If you heard how he was describing the scenario about some weakness in the first quarter, but overall a nice resolution to the year, it's similar to what we talked about on the show, and I like that. That way of thinking. I had not noticed the MACD bearish divergence, so I appreciate him pointing that out for sure. Our next segment is the Final Bar Mailbag. As I mentioned many times on the show, we love hearing from you, and particularly the opportunity to help you along your journey of analyzing the markets and making decisions in your portfolio. So let's get to some of your questions that we've received in recent weeks. Question number one: what are the key things you should do or look out for as you develop a theme or thesis that guides your investment decisions in any time frame? That is a big question that should be an hour-long answer, and I promise I will think about a way to address that maybe more deeply in a special event of some sort later on this year. But my quick answer to you is number one, a couple things I would say. Number one, think about the markets not in terms of absolutes. I would not say, this chart is going to do this. It's a buy, and that is absolute. Think of the markets and think of your investment process in terms of probabilities. It's all about probabilistic outcomes. There is a most likely scenario, and then there's some alternative scenarios. And I would not wait until something different happens to think about how you would adapt your thesis to that. I would think about all the different ways that things could play out, and then think about how you would change your positioning, what you would do to adapt to that new reality. In my time, on the institutional buy side, we would always have sort of the devil's advocate argument and have people take different sides of the investment debate, even if they didn't believe that was going to happen, just to argue the point, so we could think about what things would look like, what we would see, what we would interpret, and then we were totally prepared if something unexpected actually played out. So that's where I would start with it. Things in terms of probabilities, not just in terms of absolutes. But that is a broad question. I will think about how to address more deeply going forward. Next question: is Tesla making a new year high again? It seems you said Tesla is having a divergence. You said that in your tweets. I'd love to know what you think now. We talked a little bit in yesterday's show about that. Sorry, let me get to a chart here. Tesla. We talked about that yesterday. There was certainly a divergence. And you saw that in mid to late December, sort of going into year end. Higher highs in price, lower peaks in RSI. What's funny though, and what happens, this is why bearish divergences for me doesn't tell me to make the trade. That tells me to put it on my list and to follow it from there, because you have to follow the trend. And there are plenty of examples where a stock continues or a price continues in one direction with a lot of bearish divergences along the way. And a chart that ignores all those bearish divergences a lot of times is very telling. I think with Tesla, you can see back here in April of last year, we had a clear higher high in price. You had the lower peaks in RSI, and then it just continued higher. It didn't really pull back in a meaningful way. I think, to be honest, that speaks more to the strength in the chart of Tesla than otherwise. And it reminds me to follow the trends primarily and look for breakdowns of support, pullbacks that don't hold as a better trading signal than a divergence. Divergence puts it on your list. Use something else for the actual trigger. That's how I would think about it. The next question: I've come up with a crummy approach that's funny, for identifying entry and exit points. Averaging the stock's previous high and low and buying with a limit order set at 2% below the average price. I'm abbreviating your question. I have an equally crummy approach of exiting a stock, which is set as stop loss trailing percent, which is set at 12%. So what you're basically asking at is, where should you actually be setting some of those levels in your approach, which you affectionately phrased as crummy, was basically averaging highs and lows from yesterday and using limit orders. So, that's not bad. The fact that you're actually trying to use the range of the stock as an input, I completely am on board with. What I would maybe think about is using something like average true range, the ATR. What you're doing is literally using yesterday's range or today's range, which that's fine, but you're assuming today is a good representation of the average volatility of what that stock or what that ETF usually does. If you want to be a little more maybe comprehensive with it, use average true range, which basically tells you the average volatility, the average trading range in the stock. It's going to be a better representation of what the stock tends to do. And there are a number of things like the chandelier exits and others that we could get into that are based on an average true range. But I would be looking at the ATR and stops and trailing stops that are based more on the ATR. I think that's going to give you a better, maybe a better execution point than what you're describing there. Let's see. The common advice is to stick with stocks showing positive trends, positive strength, etc. What is the common criteria for beaten down stocks showing signs of life? So first off, thank you for listening to my table pounding message that I continue to advocate, which is for trend following. If you're going to do anything, just follow the trends. And I find a lot of investors just don't do that simple thing. And if you can follow the trends, follow the momentum, and just make your goal to be stick with trends that are working and get away from trends that aren't, overall, I think you're going to do pretty well. But there are ways to upgrade that. And what you're suggesting is more of an alternative thing. I always talk about, sort of the bottom feeding, right? Bottom fishing. Can you, look for opportunities that are coming off the low. So, if you think of the chart of Tesla, and this is just an example that I have up here, there are a number of ways you can do it. I would say number one, differentiate between things that are completely bombed out or things that are in a downtrend. So Tesla in February and March of last year in a pattern of lower highs and lower lows. The market itself in a pattern of lower lows and lower highs. A number of things happened from mid-March to mid-April that should have indicated to you that Tesla is now reverting higher. It found support at its 200-day moving average. That's point number one. It became oversold by the RSI and then came out of that region. That's number two. You made a higher low, which for the first time since that period. So any one of those, you could group a bullish signal from MACD or PPO, which would indicate a trend from down to positive. So any combination of those would be designed more to help you identify things that are in downtrends that are reverting higher. I've spent a lot of time earlier in my career with the DeMark indicators, and one of his indicators is really designed to identify trend exhaustion points. I found RSI is a great way of capturing a lot of the same stocks we would be finding through that process. Look for stocks that are RSI, the RSI is below 40, below 30. Use that not as your trade, don't just trade things based on that alone, but look at those charts and look for things that are starting to improve. So I always talk about things rotating from distribution to accumulation, which means things are oversold, then they're no longer oversold. They're a pattern of lower lows and lower highs, and all of a sudden it's a higher low, which tells you buyers are coming in and not allowing it to get back to that previous low. That is where I would start to look for some opportunities of beaten down names that are starting to work. Thanks for those questions. That's all the time we have for the mailbag. Please keep them coming. We'll do another mailbag segment at the end of this week. I'd love to answer one of your questions on the air. We need to wrap this show, though, and go to the 3 and 3 charts in 3 minutes. Let's get to it. Chart number one is the S&P using the breadth in the form of the cumulative advanced decline lines. We talked about this earlier. This is one of the core charts in my Mindful Investor Live chart list, which is represents my macro process, just looking thematically at broad price breadth and sentiment, looking at ratios and relative themes across sectors and styles. And one of the ways to look at breadth is the cumulative advanced decline line. We talked earlier about the lack of confirmation potentially, and I say potentially because it's still early on. It's a day or two old, so I like to see, if how this plays out and if you continue to get a divergence. But the first warning sign on a chart like this would be me compelled to make these more of an amber color if they no longer are making new highs while the S&P is doing so. It's still early on, but that's one of the charts I'm going to be watching over the next couple of weeks to see if we get that pullback that I think my friend Craig Johnson was talking about earlier. Chart number two is the iBuy, which is the Amplify Online Retail ETF, ticker IBUY. Basically, this is one of those online retailer e-commerce ETFs. There are a number of them that are out there. I wrote an article about these on StockCharts back in December, which you can review just to see. I think a lot of times we group these as one big group of stocks. Payment processors, online retailers, sort of it's all one big thing. But there are actually some different differentiation. I could see them spreading out a little bit in the new year. This ETF, however, continuing to making higher highs and higher lows. And I think that pattern continuing speaks to the offense still working overall. But finally, chart number three is the energy sector. If you missed it today, energy up pretty good on stronger oil prices. This is a sector that, despite the negative pattern that you saw going into the low in late October, has really chipped away a pattern of higher highs and higher lows, even with the pullback continuing to push higher. So I'd be interested to see if this low holds, and if we're able to break above the swing high, the XLE getting to around 42, I think would confirm potential for further upside there. That's our show for today, folks. Thank you so much for joining us today and every weekday on the Final Bar. I want to thank my guest, Craig Johnson from Piper Sandler, joining us from Minneapolis, sharing his thoughts on the S&P and in gold. I want to remind you, check out our YouTube channel for all of our specials, including our 2021 market outlook. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.